Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice. Episode 8.
Welcome back to another episode of the Old Fashioned Real Estate Show. I'm Brian Leverage.
And I'm Jeffrey Holst.
We're glad to be here with all of you again. If you haven't had the opportunity to do so, obviously you're finding us on YouTube, but go ahead and like and subscribe to the show, and also go to our website, oldfashionedrealestate.com, and you can learn more about what it is that we do.
We're also on Facebook and Twitter. It's Old Fashioned Real Estate on Facebook and Old Fashioned RE on Twitter.
Great. So today we're excited to talk about a topic that is hard. It's not well understood by people generally. It's called a 1031 exchange. The benefit of understanding this type of an exchange is that it can save you a lot of money when you implement this correctly over time. And Jeff, why don't you describe what it is in a little more detail that we're talking about?
Sure. So a 1031 exchange is it's actually an exchange of real estate. So basically what happens is that the tax code allows you to defer certain taxes by following certain rules in the 1031. And so that's what we're going to talk about. The basic idea would be, say I own a apartment complex and Brian owns an office building, and I say, hey Brian, I'll give you my apartment complex if you give me your office building. That's the nature of a 1031 exchange, and that's really what the tax code originally envisioned when they came up with that. They said, you know, if you're really trading one piece of property for another, it's not a taxable event. And what would happen is, you know, that would be a thing that people would do occasionally. The problem with doing that type of classic exchange is I have to have an apartment complex that Brian wants, and Brian has to have an office building that I want, and that's pretty unusual, I think. Typically, people aren't going to exchange one piece of property for another.
Right. So we'll get into in a little bit some of the different types of exchanges. But first, it's probably best to talk about some of the advantages and the disadvantages. So the advantage, Jeff, primarily is
that you can defer capital gains tax and recapture tax indefinitely.
So capital gains, just for those that are a little less familiar, when you sell your property, whatever your profit is, so if you, let's say you bought a property for $100,000, you sell it for $200,000, your profit, you know, just for simplicity's sake, would be $100,000. A long-term capital gains, assuming you owned it for more than 1 year, would be $15,000 on that. And
that depends a little bit on your tax rate, but assuming that you're in that bracket, it'd be a 15% tax rate.
Yes, there's some other things that can affect that. But, you know, going back to that, you can see at $15,000 savings on a $100,000 profit is nothing to sneeze at. So,
right, and then if you had depreciation, which is a non-cash expense that we had talked about in some previous episodes, but if you had depreciation, say you paid $100,000 for that property and sold it for $200,000, but over the last 5 years you had taken depreciation over that time, and maybe you had a basis of $50,000, let's just say, to make the math easy. You'd also defer the tax on that $50,000 because you'd be subject to depreciation recapture taxes if you were to sell at that point.
Which is probably a good segue into getting into some of the disadvantages of doing a 1031 exchange. You know, like any other tax code, you know, there's usually rules that have to be followed, and your failure to follow those rules will result in your exchange being revoked and you having to pay the tax on those gains.
Right. So there is a pretty tight time frame in the 1031. There's some transaction costs because there's paperwork that you have to do. There's a requirement that you have an intermediary involved in it. You're probably going to need a CPA involved in it. So you're going to have some extra costs that you wouldn't normally have when you're doing a sale of real estate. But for the most part, it feels a lot like a sale.
Yeah. There's also, you know, when you substitute your basis, you've got your depreciation expenses to consider. Those don't go away entirely over time.
Right, and if you have a lower basis, then you're going to have a lower depreciation expense too. So if you bought a property for $200,000, but your basis in the property you were selling was only $100,000, let's say, then your depreciation would be based on that lower substituted basis.
Sure. Probably the biggest disadvantage, though, is the time element, right? Because you have 45 days to identify a certain number of properties. You can do one or you can do three. It's better to do more just in case you're not able to purchase one.
Right, but you are limited to 3 in most cases.
Sure.
Yeah, so you could do 1, 2, or 3. There are a couple of other rules that are probably beyond the scope of this video, but the point is, and what we're talking about, I think, when we talk about these time frames is something called a delayed exchange, right? So a delayed exchange is a little bit different than the example we gave at the beginning, where I just trade straight up with Brian. Instead, this would be a situation where I might sell my property and the money would go to a third-party intermediary who would hold the money. I wouldn't have access to that money. And then within that 45-day period that Brian just described, I would identify some replacement properties, and then as long as I closed on one of those identified properties within 180 days, I would be able to purchase the new property, the replacement property for the one I gave up, without having to pay any capital gains tax. And that's sort of the most common form of a 1031 exchange.
Which again, we'll get into a little more detail on some of the other ones in a minute here. But probably the biggest disadvantage to doing a 1031 exchange, and I speak from experience on this one, is that time element. Because that clock is ticking 24 hours a day, 7 days a week from the time you first sell your initial property.
So you sold a property recently and did a 1031 exchange. Why don't you talk just briefly about how that worked?
So I sold an apartment building back in January. And I had identified, not formally mind you, but looked at a number of different properties that I thought would be a good like-kind exchange property. After doing the due diligence on a number of them, about 5 or 6 of them, I realized that none of them were really worth what the asking price was. And I started to really feel that pressure at that point, because once that 45 days has come and gone, if you haven't identified, you lose the exchange.
Yeah, so the penalty is pretty severe, right? Because if you have a significant gain and you're trying to save $50,000, $100,000, $200,000 in tax, you've already paid your intermediary, most likely, so you have some costs already, and then you're still going to owe the tax. It's not like you're going to jail or something if your exchange fails, but if you fail on identifying a property, then you can't do an exchange. It's just done. You have to pay the tax and move on.
Right. So, and last but not least, as far as disadvantages are concerned, is that once you've really started down this road, you essentially have to keep traveling that same road, because with the depreciation recapture, that tends to build over time as you exchange properties. You have more and more equity with which you'll pay a larger capital gain on eventually.
You could actually get to a point where your basis is 0 in a property because you've depreciated over a long period of time, and you might have a loan on that property because you bought progressively bigger properties during that time. So if you sell, you might actually net negative money.
Yeah.
So it can get really difficult if you've done a series of exchanges.
But there is one way around that, and that's to die, correct?
It's kind of hilarious to say it that way, but yeah, the advantage, I think it's a significant advantage to die if you have 1031s.
Really, it's an advantage to your heirs, because all those negative benefits we talked about go away, and your heirs inherit the property at its current then market value.
That's right. That's called the stepped up basis. So it is a strategy that a lot of investors employ, and that is to do a continual series of 1031s with the intent of eventually owning a piece of property that manages itself relatively easy, so that their heirs can then receive that property, and then they can sell it and not realize any gains at that point.
Yeah.
Which is it can be a really great estate planning technique, which is obviously outside of the scope of the video here. But the other thing I think that's, worth considering is there's sort of a myth that's going around in 1031s, and that is that you always have to buy something bigger. You've probably heard that, right? Like you always have to exchange up. That's not really true. You don't always have to exchange up. It's just that if you don't exchange up, you're going to pay some tax.
Mm-hmm.
So it's kind of complicated how they calculate it, but in the short version, if you sell something for $200,000 and you buy something for $150,000, you get $50,000 in cash. You're going to pay tax on that $50,000. It's called boot.
Yes, I was just about to ask that. Glad you answered before. Great minds think alike. So with that said,
Or really dumb minds think like it's one or the other.
maybe equal
Or drunk minds, maybe that's what it is.
So some of the different types of exchanges, why don't you go into a little more detail with that?
Sure. So there's the one that we talked about first, the simultaneous exchange.
Mm-hmm.
Very uncommon because it's really hard to find someone that that has that same exact property or a property that you would want to trade. The delayed exchange, which is the one we've been talking about the most, and this is by far the most common exchange. This is where you have the 45 days to identify replacement property. You have 180 days to close, and you use a third-party intermediary that escrows the cash in the in-between periods. Mm-hmm. But there's a couple of other ones that are that can be really great. So there's a thing called a reverse exchange.
Yeah, those are a lot tougher to do because it's the reverse, in case you didn't figure that out yet, of the delayed exchange. So you actually have to identify your downleg property first,
right.
And there's a lot more mechanics and a lot more expense.
So the short version is you have to buy a property with your own with cash because it's really difficult to finance if you're gonna if you're gonna play a reverse exchange game. So you've essentially got to loan to an intermediary the money to buy a property out of your own pocket.
Yep.
Then you have to identify within 45 days of making that purchase which property you're going to sell, and then you have to actually close that sale within 180 days. So it's the same time frames in reverse, which it can be really great. There's a lot of advantages to it, but it's also very tricky and it's much more expensive.
And that's why they're far less common than the delayed exchange.
And then even less common, I think, is the construction exchange, which can be either delayed construction exchange or it can be a reverse construction exchange, which I think is even more uncommon. But what a construction exchange does is it allows you to use some portion of the sale proceeds to actually renovate and improve upon the property that you're purchasing. And that's very involved because you can't touch the money, which means you have to have an intermediary that understands how to be a general contractor and figure out how to do that, and they have to be qualified under the IRS code. So I wouldn't do that without a lot of help.
So I think we've given you enough of a surface level understanding of what is a commonly misunderstood section of the IRS code. Certainly, consult with your CPA, attorney, trusted real estate advisors if you're thinking about doing something like this. But again, the cost savings over time can really add up and compound, thus increasing your net worth and income substantially.
Yeah, I would agree with that. And I think one thing that we didn't cover, which I just want to throw in here at the end, is that sometimes people think, well, if I keep exchanging, I never get money, right? Like if I sell the property, I get the money. But that's not really true. You can, by exchanging and using a strategy of refinancing, pull money out and actually have access to that equity without ever having to pay the capital gains or recapture taxes.
No. That's a good footnote to end today's episode on. We look forward to seeing you again in the future, and cheers.
Cheers.